Thank you very much for coming here. How many of you are academics? Raise your hand, please. How many of you are business people? Raise your hand. How many of you who are academics are law scholars? How many of you are economists? And how many of you are business scholars? Okay, so not too many business people and not too many business scholars. So for most of you, this will be new, completely uncharted territory, the practical use of intellectual property rights. It's not going to be about the politics or policy. It's going to be about how they are used, and in particular, how they are used by small startup companies, okay? So the point is here whether you can use intellectual property as a bargaining chip to or in collaboration with established firms. That's the main theme of this presentation. I'll go over the basic structure of the idea, and then we'll look at some new and recent trends after looking at basically historically how intellectual property has been used in the past to improve or to support business strategy, okay? So this picture I will basically skip because it's about my business experience. Nobody here is interested in that because you're not business people. So should it have been that we had business people here, I would have talked about my business experience, but it's irrelevant. So let's talk about the market for ideas. It's growing, okay? It's obvious. And I will address here you, as you meaning you are a small startup who is thinking about entering the market. And I'm supposing here that you have an idea. You have an idea for a business, and it's potentially possible that you can patent this idea. Okay, that's the setup. Now, since the market for ideas is growing, you could sell or license your idea to established firms rather than do it alone. Okay? This is a good deal for everyone. Your idea becomes easier to sell if you have a patent. That's the basic argument of why you take out a patent. Now, why would you want to do it? It's pretty simple. Well-established firms have great advantages that you don't have. You don't have any resources. You don't have any access to customers. You don't have access to capital. That's what the established companies do. Many established firms are also looking actively to buy patents from early-stage businesses. So this seems like, you know, a win-win situation. Here's a notable example of somebody who tried to do one and then the other. Edison. He directly engaged in the manufacture and sale of the electric light bulb and a phonograph. Both were complete business disasters because he wasn't a business person. He then sold his patent for the light bulb to General Electric, and GE commercialized it to great benefits for all of us. So this is an example of a very good outcome of market-related transactions where somebody sold their IP to somebody who could use it better than the inventor. So there are pros and cons of these types of market trades. They reduce the competition. It's usually a good thing for those that are associated with this kind of competition. They avoid duplicate investment. The startup does not need to take the investments that the established firms already have made. And you can engage in complementary technology development. I'll explain more what that means in a little second. The problem is, of course, Arrow's paradox of disclosure. As you're trying to sell an idea, the problem might be that in the process of selling it, you might give it away for free. Okay? So what can go wrong in this kind of a transaction or a potential transaction? If you approach these big companies, it could be that they're wily negotiators and you're completely green. It's very common. They will bring their expensive lawyers and you have none. Very common. They can try to figure out what your idea is without paying for it. And they may be difficult to deal with, and they might sugarcoat their intentions to help you. All these are very strong and possible drawbacks for engaging in potential trade with established firms. So there's a trade-off here. Do it alone or collaborate with these large gorillas. Okay? And here's a true story that was immortalized by a Hollywood movie called Flash of Genius. The big guy here is Greg Kinnear, who plays Robert Kearns, the inventor of the intermittent windshield wiper. I don't know if you heard about this story, but in 1962-63, he invented the intermittent windshield wiper, the kind of wiper that goes down, stops, and then goes up again. He took out 3 patents of this. As he was taking out his patents, he realized he wasn't able to go to the market alone. It wouldn't be possible. There was a big set of large firms in between him and the market. They were Ford, Chrysler, and the other big companies. So he went to Ford, and he proposed to install his windshield wiper in their machines. They took a really good look at his patents. They took a good look at a demo version of his intermittent windshield wiper, and then they said, no thanks, we're not interested. The next year, this particular product appeared on the Ford Mustang. Okay? Subsequently, the intermittent windshield wiper appeared on all large automobile marques and companies. And he sued. He started suing Ford and then Chrysler and later Toyota. And he won, but it took him 30 years and it ruined his life. All right, so this is a good example. Normally when I show this to people.
He did make $75 million.
He did make $10 million on suing Ford. He made 30 suing Chrysler, but he paid at least $10 million for the suit of Chrysler, and probably all of the money that he won from Ford went to legal fees. And his wife divorced him. 3 of his kids demanded they would never see him again after he got into this. It's a great movie. You should really take a look. I show it to my students, the whole 2 hours. So there's 2 key features in this trade-off, whether you want to work with these companies or not. So the first question is, how easy is it to protect your idea from being copied? Example by, for example, this mechanical device, which was dead simple to copy once they saw the prints. Second question is, well, what do you get out of it if you collaborate with these competitors? How important are their existing companies' assets to make money from your idea? If they are vast, then even if there's a small chance that you'll get screwed in the negotiation, the upside opportunity is so big that you cannot not negotiate with them. So the decision for you to go alone depends mostly on these 2 features, as exemplified by a really nice paper by Joshua Gans and Scott Stern in 2003 in Research Policy. So they outlined 4 commercialization strategies depending on whether the innovation by the startup can be protected and whether incumbents' complementary assets are really important or not. And the most beneficial type of collaboration is this ideas factories, where you have very strong excludability possibility, and where the assets of the companies that you want to negotiate with are really useful for commercializing the inventions. But not every industry is like this. There are only a few of them, in fact. So I won't go through all these 4 details. That will take about an hour. I'll just flip through and say the attacker's advantage is exemplified by, for example, disk drives. In this case, neither established firms nor inventors has any particular advantage. In the ideas factories space, we have typically biotech industry. Here, biotech companies are small, research-oriented. They produce a lot of IP, and they sell it directly to large pharmaceuticals, which are focused on marketing and sales and don't do any research themselves anymore. Then we have the problems of when you can't really preclude effective exclusivity, and the incumbents really are very strong, and so you should go to them and try to sell it to them. This is the example of the windshield wipers, but also the example of Cisco, which is known to be fair in dealing with established new companies. And so there's a bifurcation in where the market can go. It can either spiral downwards or it can establish a positive equilibrium. And then we have other types of competitions as well. And so let me now go to the importance of patents for all of this. So first of all, I want to reiterate something that's known before and others have shown, Brownwind Hall and others. Patents they're rare, okay? Only 5.5% of all manufacturing companies in the United States ever filed a patent for a 20 years period of time. But patents dominate for certain types of industries, which we here call idea factories. However, a survey of US R&D managers, where they conducted twice, 83 and 94, asked about the importance of different types of mechanisms for protecting the firm's competitive advantage, and we're talking about strategy here, so that's why I'm mentioning this, show that patents are pretty much not useful for competitive advantage purposes. This is the survey, the so-called Carnegie Mellon survey from '83 and '94, and they show that the most important type of mechanism for protecting innovation and invention is either secrecy or lead time. Lead time meaning being first and being fast, okay? And as you see here in the top panel here, secrecy is listed, patents is listed in only 7 of these 33 different industries, whereas secrecy is listed 13 as first among 13 different industries. For process innovation, secrecy is much more important. Manufacturing is, of course, also important, and patent is pretty much not useful. Okay, so we've established that patents have never been of much importance for strategic innovation purposes. They are, however, important for specific types of legal maneuvering, blocking purposes, protection against infringement suits, and in negotiations over technology rights, and that's what most of you guys are interested in here. But I want you to take a step back and realize that none of these reasons are the reasons, any strategic reasons for the use of patents, okay? That doesn't mean that these things are not useful economically in and of themselves, okay? Secrecy and speed instead are the most important for strategic aspects related to product and process innovation. Okay, so now we fast forward because those were old data from '83 and '94. And what we have today are the new industries that are based on apps and software as a service. Now, patent protection for software is generally strengthened over time with some legal decisions. And against this, we have to weight the new ways of financing for startups and the new way of operating startups. New way of financing, that's crowdfunding, and the new way of operating, that's lean startup methodology. I won't talk about lean startup methodology here, but I will mention crowdfunding as a really important new trend that will change the use of intellectual properties and patents in particular in startups. So crowdfunding might seem like an irrelevant word for you guys. Well, I think you should shift your mind if you think so. Globally, funds raised through crowdfunding expanded by 167% in 2014 to reach 16.2 billion worldwide. And as a comparison, the US venture capital funds industry is about $20 billion. So already, crowdfunding is about as large as the US venture capital fund industry, and it's growing very, very fast. It's probably already replaced it in terms of its size. So what I did for this conference was I collected some new data. It's not on this slide. This is just some background basic data about equity crowdfunding. Equity crowdfunding is not the largest type of crowdfunding. That's pre-selling of products, okay? Kickstarter, Indiegogo, and so forth. That's not what I'm talking about here. In this particular slide here, I'm presenting data about direct investments in crowdfunding campaigns in order to make money in returns, okay? Not to buy the product, okay? So one of the 2 biggest equity crowdfunding companies in Europe is Cedars. It's a UK company. It's located in London. And I have data on all their projects together with some friends near Wilken in Oxford, for example, on all projects between 2011 when they started to date. On average, their funding target was £77,000. The equity they offered for this target was 10% on average. The pre-money valuation of these companies was £1.4 million, and the number of investors on average was 71. Now, the 3 top numbers here tell you that these companies look like the companies that get business angel investment or venture capital investment. Ergo, these types of platforms, which are online, they seem to be substituting for established funding methods. The one line that's different is the bottom line, the number of investors. This is why we call it crowdfunding. 71 instead of 2 or 3, as we normally see in regular startup investing. So, we want to get to this point. What's the use of patents when raising funds for startups in these types of industries? So I searched on Seedrs and Crowdcube. These are the 2 largest UK European equity platforms. During August 2016, there were 48 projects listed there. Among those, how many stated that they used patents? There were 6 out of 48. How many of them stated that they used trademarks as a business strategy? 15 out of 48. How many of them used trade secrets? 5 out of 48. And how many of them stated that the only way that they were going to protect their business was through speed and moving fast and being first? 10 out of 48. So what you see here are numbers that are actually higher than the data that we showed before on the use of patents in the US manufacturing industry. It was 5.5%. The numbers are higher here for all different businesses, which you might expect since they're startups, but still patents is not dominating. In fact, as before in the other surveys, moving fast and being first dominates together with trademarks, which might make sense given that most of these types of businesses are based on software as a service, where trademarks are important, establishing a brand. Okay, so here are 2 statements from their websites of these projects. First one is, I just want to illustrate the thinking and coming back to the paradox of disclosure. It is impossible to have any patent protection for our products. That is the reason that it is essential for us to move quickly to establish the eWriter brand while there is little competition. Second quote, it may not be in our interest to apply for patent protection on the algorithm, as if we do so, we would need to release the full details of the invention into the public domain. So the advice from a business scholar to anyone that's interested in using patents as a method for protecting their business and as a strategy, don't worry about it. Patents seem not essential for raising funds in the new industries, which is the typical argument for why you should take out a patent, even if there's no strategic reasons to do it. And in the question of go alone versus competing directly with the established companies, my advice is to go alone only if your idea is revolutionary, only if it can be fully protected, it can't be imitated, and only if you have the same power and strength as the big firms. Now, these are 3 very tough conditions to meet. Otherwise, you should work together with large established firms, especially if you're afraid your idea might get copied quickly, which Edwin Mansfield has shown that happens for every product. And if established firms have great resources, but you should pick your partners very carefully. And my final parting advice to those of you who might be interested in strategy is please try to avoid this. Thank you very much.
That's Konishi, by the way. He weighed 580 pounds when he retired from sumo wrestling in Japan. I know that because I was living in Japan at the time when he retired. I wanted to actually talk about some macro considerations about this whole intellectual property field. And it might present some new thoughts for people in Europe. And then I want to go down to the corporate level and talk about some policy issues that affect corporations that some of you who are interested in the policy world might take into consideration. I'm going to start with and I'm doing this obviously from the point of view of being across the pond, what we see about Europe and what I would say is a lagging pace in the technology race. We've had this in the United States before. Those of you of a certain age, of which there might be two in this room, may remember that in the late 80s, there was a great feeling that the United States was falling way behind Japan. And Japan had developed a new way of doing business, a government-private sector cooperation that was going to sweep the field. And that, plus the fact that Japan didn't care about quarterly accounting reports and things of that nature, allegedly gave them a huge advantage over their American counterparts. And if that wasn't enough, they were out buying things like the Empire State Building in Pebble Beach that just heightened the paranoia at the time. Well, we all know what happened to that economic model. They had 20 years of stagnation with that model subsequently to that. Europe, however, is starting to get singled out in this area right now as well. The Economist, my favorite magazine, opined in a July 2nd article entitled Europe versus America from Clout to Rout. Europe has gone backwards in technology. It hasn't created any firms of the scale of Facebook or Google. And from the early 2000s, its tech and telecoms incumbents have proved to be poor at reinventing themselves, even as American contemporaries, including Cisco and Microsoft, learned how to evolve. The actual issue goes much further, more than this. In the 80s, the European community launched a government industry consortium called Eureka Project 95. That composed 30 manufacturers and broadcasters to develop a high-definition television standard known as HD-MAC. It was backed by hundreds of millions of euros in government mandates and funding. Not to be outdone, the Japanese came up with one called Hi-Vision that tried to do the same thing for its incumbent consumer electronics industry as well. And so what happened? Well, they both ended up on the scrap heap. They were outflanked by an entrepreneurial U.S. startup named General Instruments, which didn't follow the analog model. In fact, it invented the first digital high-definition television program or model, which swept the field. In other words, and this is the key point, where government mandates, aspirations, projections, and especially funding for industry incumbents failed, free markets, entrepreneurialism, and risk-taking succeeded. But as you all know, and though many of you raised your hands when Tom asked you the question of how many of you were in the policy world, these habits are difficult to break. And they keep aborting, in part because whole bureaucracies depend on them. So consider, for example, and this is where Tom and I might differ a bit, 6 major global industries launched over the past half-century: semiconductors, personal computers, software, biotech, browser-enabled internet e-commerce, and smartphones, are each based on a foundation of patented innovation, enthusiastically pursued by U.S. companies that generally dominate in these areas. And not just U.S. companies, by the way. You walk around Seoul, Korea, you'll see a few people who are interested in this stuff as well. Yet today in America, and this is where there's a policy advantage, I think, in Europe, in an overreaction to the well-known troll problem. Any of you know what the troll problem is? If you do, raise your hand so I can get, okay. It's infected you guys as well. Patents are being devalued in the United States right now as a result of this, and often rendered unenforceable thanks to recent U.S. Supreme Court cases like Alice and Myriad, and recently adopted patent office procedures called inter partes review. Taken together, if you challenge a patent right now, you have a 90% chance of winning, which means there's a 90% chance right now that your patent will be disallowed in the United States. This is especially true in the world of software. Maybe this is an overcorrection that will be fixed over time, but for now, the situation is reasonably acute. And regardless of what you might think about software patents, there are 2 things that are very clear. One is software is the sine qua non of virtually every industry right now in the world. I don't care what the industry is. Second of all, it's almost impossible to tell the difference if a patent is in software or hardware or firmware or whatever. How it's implemented, you can't tell. So this is a distinction largely based on, without a difference, based on trade-offs over speed and cost. Suffice it to say, though, American companies are finding it increasingly difficult to patent and protect many of their highest value ideas, products, and services. These typically involve advanced technologies such as cloud computing, big data, machine learning, connectivity, mobility, business processes, and anything as a service. But in other words, this is the future. And right now in the United States, it's very difficult to patent this thing. Is this potentially advantage Europe? Well, Europe has yet to succumb to America's patent devaluation fever and perhaps never will. But it raises several questions. Could resources for cutting-edge innovation shift toward Europe, where they might be more easily protected and monetized? Consider the following fact. Right now, U.S. companies have, and it's basically the high-tech world, somewhere between $2.1 and $2.5 trillion ensconced in Europe. Now, why? Because they don't want to bring it back to the United States. Because the United States blended tax rate for corporations right now is 39%. In Europe, it's about 22%. In Ireland, it's about, depending on who you are, it could be as low as 1%. Not clear. But this is a huge problem if you're an American company right now, because you're not going to bring it back and have to explain to your shareholders why half of it is gone to the U.S. Treasury. But it's an old axiom. Money flows where it's best treated. And along these lines, I think there's much Europe could do, but I fear it won't. First, in my estimation, there is much that could be done in cutting back on the bureaucratic, I'm going to get in real trouble here, the bureaucratic spending Brussels seems to be inflicting on its member states. Anybody who just walks around Brussels for a day and just looks up in the air instead of at the ground will know what I'm talking about. Second, consider the tolls being taken on member states supporting industries that might be better off fending for themselves. Along my my earlier example, rather than being, as my Irish father-in-law would put it, on the dole. There's a recent article by Werner Hoyer, head of the European Investment Bank. He decries the innovation gap between Europe and the United States, claiming it's high time to remedy decades of European underspending. He goes on to list the financial requirements to close this gap. Here you go. 130 billion euros annually to meet the EU's 3% target of GDP for R&D. 90 billion euros a year for advanced manufacturing. 35 billion a year to match U.S. venture financing. 10 billion annually for state-of-the-art education facilities, and another 65 billion a year to reach EU targets for broadband data centers and cybersecurity. Where that's going to come from, he doesn't cover. So I can't talk about that. But these are vast sums. Now, however, the support for these incumbents, however, goes well beyond proposed additional financing. It seems to me, and if you scratch most American technology executives, they would say this, there is a consistent effort to throw tax in the runway of successful U.S. technology firms, especially some that you know well right now. But I've spent a lot of my time in front of DG13 in Brussels, and I can tell you that it's not a happy experience. Just to give you names of some of the companies that have spent a lot of time there: Microsoft, IBM, Intel, Google, Amazon, Facebook, all of them. And the list could go on and on and on. Now, you all know this. The Commission seems to have done itself recently, about a week ago, less than a week ago, given its tax ruling involving Apple. The claim here is that Apple shifted its profits to an Irish subsidiary to pay a lower negotiated rate than the Commission was happy with. In this case, the Commission seems to, what we would say in the United States, have won the trifecta. They've irritated Apple, they've irritated Ireland, they've irritated the U.S. government. This is very hard to do, but they managed. We have U.S. congressmen right now calling this a European money grab. And on Friday, Tim Cook, the CEO of Apple, stated that Apple is going to start pulling money out of Europe now for the first time. as a result of this. Now, whether it will or not, I don't know. There's a big political game going on, as you might expect on all of this. Anyway, are there more opportunities for Europe now to establish itself in a favorable position? I think the answer to that is yes. But there's a lot that we could do on the micro level of policy issues that I think are important. And since we're in academia here, I'm going to bring some of these up which affect academia. I think Tom would probably agree with me on this, that IP is currently undervalued by governments and alarmingly by the very companies it might be able to protect and assist. Why? Well, is it because there's no direct link between IP and the company's stock price? Is it because of failures in our academic world that generally ignore intellectual property in law, business, and especially accounting? Is it because, except in rare instances, IP is not reflected on the balance sheet of corporations, in spite of the fact that academics will argue and economists that some 70–80% of the value of a modern corporation is in its intellectual property? Are there structural reasons? Is it laziness? Do we have the wrong people in ownership positions? Are senior managers and the boards of directors under-involved? Or is it all of these and more? The answer is all of these and more. So under the rubric of physician heal thyself, easy for me to say, I'll offer the following. When I began my business career ages ago, I discovered that the vast majority of companies, pharma being a notable exception, were completely blind to the value of intellectual property. CEOs and boards saw it simply as legal instrumentation, never considering their strategic or financial value. At most, they were viewed as negative rights, which, as Tom told you, is the ability to exclude somebody from doing what you're doing. But then some high-profile business stories erupted in the early 90s. Polaroid used to make cameras that were instant film. Successfully sued the then behemoth Eastman Kodak for patent infringement and collected $1 billion in 1992 and forced the closing of Kodak's instant camera factory. In that same period, IBM on the ropes, about to lay off 200,000+ employees, down to $100 million in cash and on the brink of bankruptcy. A former Chinese history major convinced then CEO Lou Gerstner and that perhaps IBM could make some money licensing its extensive patent portfolio. That history major, who happens to be standing in front of you, began an effort that resulted in a $2 billion profit annually to IBM by year's end. By the way, it cost me $36 million at the most annually to raise $2 billion. It was a pretty good deal for the company. And that was at a time when $1 billion meant something. And that attracted a huge amount of notice in the business press. And a couple of friends of mine wrote a book laying out IP as a strategic asset called Rembrandts in the Attic, and the rest was history. So today, most CEOs will not argue the point that IP is a key currency of modern business and represents a big chunk, if not 70–80% of the firm's value. But when asked what they plan on using these assets for, most will say, well, we surely do. Just head down the hall to the legal department and ask them how we're going to do it. Thus, most patents instead sit in the file cabinets of legal, gathering dust, not generating sufficient income, building market share, blocking erstwhile competitors, creating new alliances, helping entry into new markets, or doing a host of things that IP could do to help achieve business goals. Now, I just came back from Silicon Valley, where I met with 7 companies that are household names and international technology leaders. If I asked you all to name those 7, I bet you we'd get about a 95% hit rate in this room on who they are. These 70 companies would each acknowledge the importance of intellectual property to their success, but in every case, the IP management of IP languishes in the legal function, not with higher management or the CEO, much less their boards of directors. Now, I can't overemphasize the importance of higher management involvement in this field. I'll just give you a quick Microsoft story. When I joined Microsoft in 2003, Microsoft had fewer than 300 patents and applications combined. Today they have 68, 69,000, some number like that. How did they get there in such a short period of time. It wouldn't have happened without Bill Gates, quite frankly. What Bill Gates did was two things. One is he actually sat down and we would go through the strategic annual plan of each division of the company by what they did, unit of work, and give them patenting targets for that work. And he would write them each a letter and say, for your telecom business, you pick the area, it doesn't matter. I'm expecting you to come up with 400 patent applications this year. And oh, by the way, it's a part of your job performance, which is code for if you don't do it, you're gone. And so he did that. The other thing he did was he participated in something we called forward patenting. It's kind of a cool thing I brought with me from IBM. We would sit down with the top researchers and developers in the company, and we would take a look at the world 5 years out, which is always hazardous. And we would try to patent in those 5-year periods ahead. What would be important 5 years from now? You might say, well, now, that really is a fool's errand. Well, the first meeting we had, which was in June of 2003, Bill walked into the room, it's an absolute true story, and said, I don't know what it is, but I think something called cloud computing is going to be really important. And we're all looking at each other because none of us had any idea what cloud computing was either. But we sat down and we started writing patent applications in cloud computing. And lo and behold, that forms the basis now for what I think is probably the strongest patent portfolio in that area in the world today. But it was done on a wing and a prayer in those things. By the way, it was kind of neat what happened organizationally. Once word got out that Bill was attending these meetings for the day, we had to fight people off with a stick who wanted to attend and just be part of that whole process. But boy, think what that does culturally for a company on the subject matter like this. And tell me another company where you find the CEO doing that kind of thing. It was really quite amazing. So anyway, that's the exception rather than the rule. Lots of things have been tried to get higher management involvement. There have been conferences, there have been papers, there have been forums, there have been this, that, and the other thing. To little avail, frankly. So a couple of quick recommendations. What could we do? One is change the people who run this thing inside of companies. They ought to be the elite of the company, not just by default going to the non-elites or the legal department. And I'm a proud member of that profession. I don't want to pick on them, but they're not really known for activism and pushing an economic agenda forward. What they really are is a corporate Maginot line in most cases. Second of all, not to be too hard on CEOs and boards, they came of age and were educated at a time when physical assets are what you counted. And 80% of the value of a corporation was the physical assets. Now that's flipped, but the education hasn't flipped, and the CEOs therefore haven't flipped, and the accounting system hasn't flipped. In fact, in the United States at least, and I think most of the developed world, you do not see this stuff on balance sheets or frankly on income statements unless there's been some kind of a transaction where it has to be reflected. So those are kinds of things that have to change. For those of you in education, there is very little, and you can look at your books out there that are for sale, there's very little in professional literature that integrates IP management into the broader array of managerial skills taught today in business schools. When I went to business school, it wasn't even covered at all. So anyway, I better wrap up here because I'm getting the high sign and I'm about to die. I've really tried to talk about, and there's just one other benefit about putting this stuff on balance sheets. That disconnect between stock value price and intellectual property would disintegrate the minute this stuff showed up on balance sheets, because the analysts of the world would start saying, well, what did you do with those assets? And then you'd have another flurry of activity that many companies don't particularly want anybody to peer into. But enough of that. So there were two things I wanted to talk about. I think the time may be right for Europe to give the US a run for its money on innovation and IP leadership. That's going to require a lot. And of course, it all comes down to the atmosphere that's available to companies. And we know a little bit about where that is as of this week. And the second thing, I've tried to show you that even with the best public policies in place, companies and the institutions that support them can and should do a much better job in managing IP and innovation assets than they're doing at the present time. So I'll stop there and go on to questions. Thank you.